Welcome to Bloomberg ETF IQ. I'm Scarlett Fu. Let's get to the biggest stories right now in the nearly $22 trillion global ETF industry. Oil prices sliding after the U.S. and Iran's pause on strikes extend to a third day following almost 2 weeks of daily military action. Plus, ETFs head for back-to-back triple crowns. We discuss what's driving this kind of performance with Cinthia Murphy of TMX VettaFi. And a Bloomberg Big Take sets up a debate on whether ETFs help the uber-rich dodge taxes. We'll speak with Brent Sullivan of Tax Alpha Insider. As always, Eric Balchunas from Bloomberg Intelligence is here with us. What do you got, Eric?
Thank you, Scarlett. So, look, the flows are pretty good. We've got VU at the top here. We've got SPYM in there. SPYM, as you know, is the big challenger to VU. Both of those are S&P 500 ETFs, boom and boom. And then you've got SPY itself up here. That's the trading crowd. VTI. Gold, interesting. Gold has really been in the doghouse lately, but a little buying of the dip there, I guess. And then DRAM and EWI. This is the South Korea and the memory chip ETF. They both really are a play on SK Hynix and Samsung and that whole trade. They've been raking in the money all year. Let's look at the outflows. The outflows, you'll see some money out of IVV. So again, not a totally net bullish trade here last week. Now, money coming out of SOX and SMH, both semis, interesting. You see money going into DRAM and South Korea, but out of semis, what's up with that? These are more the trading crowd. They tend to go opposite of a rebound. So I think money's trying to take some profits here. And yet the retail people, they're still buying into that memory trade. They're not giving up yet. Some money out of growth and a little bit out of small caps. It was just in the leaderboard last week. Now, I want to take stock here of the first half. I know we're deep into July, and July's been a huge month. So it does continue this, but I thought we didn't get a chance to go over the first half results of the possible triple crown. Last year, as we know, ETFs broke records in all three major categories. That would be flows, volume, and launches, right? That's why they call the triple crown. Typically, if flows are big, the market's up, launches are up, but volume only tends to go up in bad years because people trade more when there's a crisis. Well, last year, they all saw records. So in the first half, 1 trillion into flows, well, 1 trillion of flows, 40 trillion in volume, and 730 launches. Now, let's just say that continued in the second half. You'd be 2 trillion in flows, 80 trillion in volume, and 1,460 launches, which is just mind-numbing to think about. That would be 35, 35, and 30% over the record, and the record was just last year. So again, triple crowns only happen about once every 5 or 6 years. So to have back-to-back triple crowns, Scarlett, is just remarkable. There's still plenty of time on the clock. You know, a bear market might derail this, but for now, it looks really good for just another stunning year.
All right, Eric, that's a great setup because joining our conversation right now is Cinthia Murphy. She's investment strategist at TMX VettaFi. So you saw the numbers there for triple crowns and how ETFs will break all three categories if we progress at the same pace by more than 30% this year. There's no let-up in the pace of issuance, clearly, and I believe the Wall Street Journal called it an ETF crazy train, borrowing Eric's penchant for pop culture references. What do you chalk this up to?
I think it's really a confluence of factors. We have a market that continues to defy gravity. You know, the more we talk about concerns about valuation, concerns about concentration, the more we buy some of the leaders, the more they lead. Anytime they reset, we buy more of the dip. So it's a market that keeps on going. I think it keeps feeding this momentum, and momentum is great for not only product innovation, where more asset managers want to come into the game. It leads to more trading. Folks are looking for more opportunities. And so it just keeps going. And flows, I think we're a little bit like the Mag 7 now. If we don't exceed expectations by a wide margin, it's such a letdown that we're just going to keep feeding this machine because we have to.
Last year's ETF in depth, I said, is this as good as it gets? Because, again, it's just a rare thing to break all three records. The volume record is interesting to me because typically, volume only goes up if there's a crisis. It's correlated to the VIX.
A massive sell-off.
Yes, because people start tweaking their portfolio. SPY and these ETFs see a lot of volume. So what do you make of the volume? My theory is that there's just so many more products, and you got all these legacy asset managers coming in. So it's just way more activity. And also marches under Trump have been really crisis central. So there has been a little crisis. But I think that is what is lifting the volume up, that and maybe bigger investors using ETFs, so that notional number goes up just because there's bigger investors using them? Do you have any theory on the volume?
Yeah, I wonder if it has something to do with, we spent the last couple years talking about 60-40 no longer works. So all of a sudden we created this 20 to 30% sleeve that has to go somewhere else. And maybe folks are, moving that money around, trying to figure out what is the right mix now that is no longer a 60-40 mix. And I mean, look at all the leverage stuff. I mean, have we ever talked about leverage this much? So leverage is all about daily trading. So how much is the volume we're seeing associated with those types of tickers too? So again, just different forces, I think, and to your point. So many more products on the menu. Maybe folks are more eager to reposition and trade than they were before.
And people are holding on to ETFs and buying and holding for longer as well, including people that you don't necessarily think would do so. We spoke with Ed Yardeni of Yardeni Research on Friday on Bloomberg Money, and we're asking him about how he invests his personal investments. Take a listen to what he said.
Well, I found over the years that I can't really trade. I can't really manage my own money because I'm too busy doing my day job. So I try to basically stay in ETFs and keep things somewhat liquid, but also have stocks and bonds, but mostly in an ETF portfolio.
So Ed Yardeni talking on Bloomberg Money. Eric, I feel like that's not something you would have heard a couple years ago necessarily.
Yeah, or at least they would be in the closet still. Because I remember when I wrote my book on institutional use of ETFs, I would interview these CIOs from like big institutions and endowments, and they'd be like, oh, well, I hire active managers for our fund, but in my personal account, I'm all into ETFs. And I find that to be true in the financial industry in general. I think we're used sort of like secretly, not secretly, but in personal accounts, but now they're seeping into regular accounts. And yeah, I think there's more products, but generally this person who just spoke here, I think they're probably in VU. Probably just some
VU and chill.
He's probably VUing and chilling. I mean, everybody is, honestly.
As should everybody, yes.
Let's shift gears here to, speaking of VU, you have VU. It's S&P 500. All you talk about it, or you hear about, is concentration. I think the top 7 or 8 stocks make up like 40% of the index now. People are worried. Now there's equal weighting. Equal weighting is always this like temptation. It's now outperforming this year. Is this just a red herring and market cap will take back over? Like, what's your take on those two? Because we see flows into both, but of course way more flows into the S&P 500 ETFs.
Yeah, it's one of those things where we keep pushing the narrative that concentration should not work anymore. As long as it keeps working, we're going to keep seeing money going into that. Right now, this year, equal weighting is delivering. I mean, equal weighting really doesn't work well when you have a really narrow market leadership, as we know. So now with the broadening of the performance, with the earnings really talking a lot about the 493, as we call them, and the earnings growth being stronger in the 493 than it is on the Mag 7 going forward earnings. So there is a potential for equal weight to really make an impression here. It's outperforming this year, but as we know, that the moment it goes to narrow leadership, we all kind of forget about equal weightings. But funds like RSP is on top flows this year. You have QEW. Now we have ProShares that just launched an equal weighted leverage Qs. So, I mean, when we're leveraging equal weighting, I mean, talk about a moment in time when we're trying to combine all the forces driving the market. So here we are.
Leverage equal weighting is pretty funny. It's like, how into this premise are you?
Exactly.
Okay, why don't we go all the way?
How many different ways can you tweak the existing formula and then double down or triple down on it? I mean, it feels like whatever market theme exists, there's a bunch of ETFs that crop up for it the next day or even before it begins trading in the case of a couple of prominent IPOs. Eric, you posted recently on social media the top launches of ETFs ever, and if you take a look at the list, I guess it's not a huge surprise what's top of list, which is DRAM.
Yeah.
Which is, a theme ETF, right? Theme investing. That
is a shocker.
But has continued to do very well because of the momentum behind that trade. It feels like everything is ETF-iable, if that's a word.
Absolutely. Theme ETFs tend to not be at the very top. They're always scattered. But DRAM is a total phenomenon. I mean, shocker.
27 billion.
And then IQMM is this sort of money market fund. That's a lot of ProShares' own money. So a lot of bespoke stuff usually ends up at the top. But DRAM, again, I just think this is, again, the biggest ETF since IBIT, really, in terms of flows. And people aren't really shaken out. It's had a little bit of a downturn, but people still keep coming in. What do you make of that?
Yeah, I think it's really the story of the bottlenecks. So memory is the bottleneck, the current bottleneck on the AI story. So if you're bullish in the AI story, that is the point where it has to grow dramatically or the AI doesn't materialize. So it's a great bottleneck. It's a really strong theme. I think the next coming up is photonics. We had 2 photonics ETFs launch.
Photonics?
Yeah, which is carrying data through light waves, right? Because the copper cables aren't capable enough for the kind of data we need. So the point is the bottlenecks make really powerful themes within the AI story, which I think has been a really interesting phenomenon.
That when we had Athanasios on, and he's our curmudgeon, he saw there's a speed of light ETF, and he's like, I'm out. He can't handle it. But yeah, there's
He
about...
just dismissed it entirely.
Yeah, there's 30 or 40 AI ETFs filed. DRAM really just like, everybody's like seeing that and
they're like,
in.
how can I come up with my own version of DRAM?
Yes, absolutely.
Photonics is clearly the next one.
A lot of spaghetti.
Yeah.
Just throwing at the
It's a
wall.
big
Some of them
wall, though.
stick. Yeah.
But they're all parts of what? The AI infrastructure story. So I think there's like something like a real physical supply limitation here that can't meet demand. So it's a real case of supply and demand here. So I think it has grounds.
Cinthia Murphy of TMX VettaFi, stick around because you're going to join us back in the later half of the hour when we have our ETF quiz, IQ quiz, and we're going to put her to the test and see how she does compared to Eric.
You don't have to watch,
I
folks.
stand. No, we're all going to watch. All right, coming up on ETF IQ, we're going to drill down into real estate with David Auerbach of Hoya Capital next. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu. It's time for today's drill down where we focus on one ETF. Eric, what do you have for us?
Scarlett, today we are going to the REIT sector. We haven't been here in like a year, I feel like. So Hoya Capital High Dividend Yield ETF, the ticker RIET, so REIT almost. But this is essentially an ETF that goes out and looks for the 100 highest yielding REITs, but with a quality screen to try to get rid of some junk that the yield might not be worth it. So that's what you're getting with this. It's a multi-factor approach, so it's not active. It is index-based, but when you use multi-factor, it's got a lot of active in the design. 50 bips, about average for the sector. $100 million. Let's look at the yield. You know, REITs are interesting. Like you can, be bullish the sector, but most people who go into REITs want the yield, right? Look at the yield here, 10%, right? That's what's getting people into REITs. It's almost like a fixed income attribute. And when you have bonds yielding, less than half of that, you can see why people get into REITs for that purpose. Now let's look at the performance of this. I put it up against VNQ. That's the big one in the market, but that's really probably not the best benchmark, but I tried to do something. So you can see it came out in 2021. So this is about 5 years. So you see here, it's up 3.5%. It is trailing VNQ. It'll probably have to turn that around to get more flows. But look at the amount that came from the yield. It's 34% down in price, but all that yield helped it here. So that's why that income is important to some people, even more than the performance, Scarlett. So yes, RIET.
All right, we're going to check on that because that confused me when I was trying to type it into the terminal. Eric, thank you so much for that setup. Joining us now to talk about RIET, the ETF, is David Auerbach, CIO of Hoya Capital. And let me just start there because REITs are real estate investment trusts, so it's the acronym is REIT, yet the ticker for this ETF, which invests in REITs, is RIET. That can be kind of confusing.
Well, we take an income-first approach, so I before E. And as Eric mentioned, with so much of the income being generated, we focus more towards the small caps, the mid caps, the preferreds, the mortgage REITs. That's what's kind of pushing that yield number higher.
Did you pick the ticker based on that little phrase you just gave us, or did you come up with the phrase after you realized people had this question?
No, we came in with it, going into that with that phrase.
It was intentional.
It's pretty good.
It was
That's
intentional.
hardcore. Yeah.
We're not here to voo and chill. We're here to REITs and chill today.
All right, well said. I guess the obvious question here right now, especially on a week in which the Federal Reserve is meeting, is that the market anticipates a hawkish Fed. That's what we've gotten so far. The odds of a July rate cut are now 1 in 3. At the very least, they're going to do nothing and will be higher for longer. REITs don't typically do well in a rising rate environment. So what's the case for buying REITs now?
So it would be but. REITs have been doing well in a high rate environment. REITs have been operating in a high for long environment for so long that it's business as usual. Operating fundamentals are up, dividends are up, M&A transaction activity is up very large. So management teams are not going to wait for the Fed. They're going to find ways to unlock value, especially when you look at valuation between private real estate and public traded REITs. And that's why you're seeing private equity players and private capital, frankly, chasing a lot of these REIT deals because they're able to buy these public companies at discounts to net asset value.
So let's talk about the chart I showed with VNQ. That's what, I mean, believe it or not, that is the biggest REIT ETF by far. It's a huge hit. It's market cap weighted, though. So you have a couple stocks that make up a chunk of the weighting. You're more like equal weighted. So when someone says, well, hey, why don't I just buy VNQ? The performance is better. What do you say in response to that?
Be my guest, but so much of that weighting is in the top 10 holdings. There is no yield in those top 10. And that VNQ is driven by names that have been on fire this year, such as Digital Realty Trust, DLR, American Tower, Welltower, Prologis, the largest players where you're really not going to find that much dividend income versus, frankly, where the real opportunity set lies in the small caps or the mid cap space.
So, and how, when we think about somebody looking for a REIT ETF, what percentage of them are looking for yield only? They don't even know what these things do. They just want the yield.
We think most of the investor base is when you buy REITs, you buy it for income. I like to say when you buy a REIT, you're buying it for the dividend income stream. Anything that happens with stock price appreciation is the extra cherry on top of the sundae. When you buy REITs, though, you've got to figure out, is the dividend sound? Is net income going up because net income is that dividend? And so for REITs that have been operating in this volatile environment that you've been talking about, over the big picture, this is what dividends have been doing. And when you think about owning REITs over 25, 50 years in a portfolio as the ballast of that ship, that dividend income is going to compound dramatically over that course of time.
So it makes it a substitute or an alternative to fixed income. We're looking at, allocations, people don't believe in the 60-40 portfolio necessarily, but I'm wondering how REITs fit in to someone's portfolio if someone's not all that jazzed about taking a long duration.
So obviously it depends on where you are in the cycle as an investor. I always like to say as soon as your child is born, your grandchild is born, buy them a monthly dividend paying REIT that you can reinvest those dividends. But to directly answer your question, I like to say that REITs are a great complement towards your fixed income, your BDCs, your MLPs, that great utilities, that great income package that you can build that allows you to then go play SK Hynix or Bitcoin or some of this other stuff. It's that safety net that you're looking for in your portfolio.
I want to bring up generally in REITs, one thing we found interesting, James and my team did this research. If you look at passive ownership of sectors, REITs is far and away the most owned by passive.
Why is that?
It's because the smart beta ETFs that go after dividends and yield, they love REITs. So you end up with more REIT ownership from passive ETFs due to smart beta. Here's a look. You can see here real estate and utilities, same reason. Utilities also a yield play. What do you make of that? We've had a couple cases where there's been REITs where it had more than half of their shares owned by index funds.
Love that chart. It's great. And I think it's great because when you think about a typical REIT, the long-term lease nature that's in place with most of these sectors, 5 years, 10 years, up into a company like Safehold with a 99-year ground lease, you can track that dividend income. And so for a lot of these passive players, they know what that dividend income stream is going to look like over time. We like to think that RIET is a great complement to a VNQ because frankly, it's top down, bottom up. And so it's a great hedge to play both sides of the equation.
How exposed is RIET to data centers? Because that is the big story right now when it comes to real estate and AI.
Yeah, we definitely have exposure to some of the data center REITs, but I think the other key part of that is the amount of industrial space that's being developed because of data centers. So it's almost like they're going hand in hand with each other, that one sector benefits from the other sector. I still think we're in the early innings when it comes to the world of data centers, but we have two established, really, there's 4 established data center REITs, if you count Blackstone's new REIT that listed here recently, along with a company called Fermi that listed last year. We're not going to talk about Fermi. But we're still in the early innings of this game that with so many of these private players that want to launch data centers, that's great. We have, again, established platforms with a global footprint that own tons of megawattage of power and properties already, that when you have established dominant players in the space, they're working hand in hand with local municipalities like New York or some of these other places to try to get these issues over the hump. So, I don't necessarily think it's a red flag.
All right, David, thank you so much. David Auerbach of Hoya Capital with RIET for our drill down. And you can read all about RIET and this drill down in the very latest in the ETF industry when you subscribe to the weekly ETF IQ newsletter. This is ETF IQ on Bloomberg. It is time to take a look at the Bloomberg Intelligence traffic light system, which ranks ETFs by risk levels. And I was just commenting on how one of these ETFs is crazy because green light means low risk, yellow light means moderate risk. And Eric Balchunas has an ETF for us that's red light, and like red light times like 3. Eric, what do you have for us?
Yeah, so this is the biggest leverage ETF on the planet, TQQQ. It's the ProShares triple leveraged Qs, right? And it's interesting, you know, we talk about red lights and be careful out there because these ETFs have volatility drag, et cetera.
Right.
But this particular ETF, even though it's red light for heavy leveraged and daily resetting of leverage, which has vol drag, it's up 41,000% since it came out. And what's interesting is the people using it have been really smart. When it's down, they buy into it. And then when it goes up, they take profits.
They're buying low and selling high.
Yeah. And so over the course of the lifetime of this ETF, it's seen 12 billion of outflows, and it has 32 billion. So it's close.
Interesting.
So that means it's close to $50 billion in gains. And this, to me, is why these leverage ETFs are critic-proof. They're like, because everybody dumps on them, but the degen traders using them are like, I don't really care what you say. I'm making a mint here. They're using it as an ATM machine.
It totally works
effectively.
For them.
Okay, well, I thought we had a picture of the outflows.
Oh, we don't
there,
have the. Okay, so go to Eric's research, BI ETF on the Bloomberg terminal, and you can see the chart that really highlights how much in profits these guys have made from this ETF's performance. It's pretty incredible. What did you say, 42,000% since
41,000%, which is 22 times QQQ. However, you got to be very careful. That's not the norm.
Yeah. Be careful
It's a
with
perfect
this.
scenario.
It's a red light.
Yeah.
All right, coming up, strong ETF performance is causing some ultra-wealthy investors to turn to 351 conversions. We've got more on this next. Welcome back to Bloomberg ETF IQ. I'm Scarlett Fu with Eric Balchunas. Wealthy investors are taking advantage of ETFs by using a bespoke fund called a 351 conversion. This move allows investors to turn a portfolio into an ETF, typically so they can rebalance winning holdings without paying an immediate tax bill. Let's talk more about this with Bloomberg News reporter and Pulitzer Prize winner, Zach Miter. He co-authored this story. It was last week's Big Take. Zach, it's great to see you here on set. This is basically about how wealthy families can create or convert their own personal stock holdings into ETFs in order to defer taxes. And I pause there because it's deferral, not dodging, right?
It's deferral, at least in the first step. Whether they actually end up having to pay in the end of the day is another question. But basically, if you, so many people just have these huge gains from the stock market in the last few years. And so it becomes a question, is there some way we could say, get out of an NVIDIA position that went really well and diversify into some other things? And this is the kind of opportunity that people are taking nowadays to do that, to be able to switch into exposure to other stocks without having to pay the tax that would normally entail if you were to just sell it.
Without triggering a tax bill, essentially capital gains. BN crunched the numbers, and you guys looked at the growth of this class of ETFs. How quickly are these growing? How much in capital gains, therefore, have been deferred by your estimation?
Right. So it's most of the creation has just been in the last 2 years or so. And we counted up over $20 billion of sort of funds created and at least over $6 billion of gains that were deferred. So those are gains that rather than having to pay, those investors will be able to kind of keep holding those winnings, keep reinvesting them in the market, and maybe pay them later on or never at all.
Okay, so let's go over this. I think the word dodge also, I got hung up on this because, okay, so you bring your NVIDIA into this customized ETF, it gets diversified. A lot of people also just don't want to sit on one stock. It took over their whole portfolio. So they want to like Vanguardize their portfolio. They move into this diversified ETF. And then let's say, 7, 8 years goes by, you sell, you still have the basis of which you bought NVIDIA. So you're still on the hook for the complete tax bill. The question is, should the government have had that money right when you wanted to get out of NVIDIA,
Right.
so it could, like, I don't know, do something with it, pay somebody's Social Security. Hopefully it's running out.
TSA, among other things.
I get
yeah.
it. But at the end, you still are on the hook, or do you find they're able to wash that out somehow, which would be more of a dodge than a deferral?
Well, so that would be a separate move, but there are, if you talk to estate planners, there are lots of ways to do that, because ultimately, when you die, your heirs receive your assets with a step up in basis. And so, for instance, if you were to, once you converted this through 351, convert to, say, the S&P, and just held it and left it to your heirs, then they would get the benefit of that without either you or them having to pay tax on the gain. So that's one way it can happen. But you're right, sometimes people might, after a few years, they might end up having to pay.
Okay, let's go after this ultra-rich thing, too, because I get it, like, the top 1% own half the stock market, so clearly they are the ones who would be involved with most things stock-related. But there's still like 20, 25 million people who own ETFs. Some are middle class. And the argument that I might have to counter this is, hey, well, if you are in the middle class, upper middle class, and not top 1%, isn't this a way to get in on something that the really rich have been doing for ages with private banks?
Yeah, that's an argument that people like Wes Gray at Alpha Architects have made, is this is kind of democratizing something that maybe these bespoke strategies were only available to the truly 0.001%. Now, there's an element of truth to that, but there's also, if you look at some of these deals that are subscriptions where multiple people put their money together in a 351, the minimum you can invest is $1 million. That's not your total wealth, that's just what you're putting in. So, and then you see individual families who are billionaires who are putting in hundreds of millions of dollars personally. That's the kind of transaction that's not available to most of us.
All right, I want to bring in Brent Sullivan. He is editor of Tax Alpha Insider, and he was featured in Zach's Big Take, saying high net worth folks and their advisors see this as a slam dunk. Brent joins us now with more. Brent, I want to first start with the 351 part of the tax code. It's a specific part of the tax code. Just walk us through, what does that section 351 allow? What does it not allow, to help us understand what's legal, what's not legal, or what might be questionably legal?
Well, so the thing to understand is that Section 351 is a 100-year-old provision in the tax code, roughly. And what it allows is for folks to contribute appreciated securities into seeding a new corporation, in this case, an ETF. Now, Congress was pretty clear about what they're trying to achieve with this. They want to help bootstrap new businesses. They do not want to allow tax-free diversification. And so that's where we start to get into the difference between routine applications of Section 351 versus aggressive tax planning. And that's the change that Treasury was talking about at a big meeting last week in New York.
How will this play out? In reality, if Treasury wants to do something, are they going to give guidance? And then will the ones already approved be okay, but new ones can't crop up? Like, how do you see this playing out?
Well, there's three different layers to this. So we have to start with statute. So that's what the United States Congress and Senate and the president are all involved with. And as far as I can tell, there's really no momentum at that layer to make a change in the law. So now we have to move down a layer. We have to go into regulation. And so those are the rules that Treasury writes and that IRS enforces. So the rules and the applications of the rules. And so it's possible that Treasury could look at how the market is actually using Section 351 and say, no, that's contrary to Congress's intent, which again, namely, was preventing tax-free diversification and really eliminating gains or avoiding gains indefinitely for portfolio rebalancing. And so they're going to look at these three different layers, and those are the different aspects that I can see that might be impacted or that might impact the ETF markets going forward.
So the thing with these 351 conversions, these new ETFs, is that they're seeded with securities rather than cash. And that in and of itself is not against the law. And if you have a diversified portfolio, that seems to be okay. But if you have a bunch of stock because your friend founded NVIDIA and you got it and now you want to put that into an ETF, does that become a problem?
Yeah, definitely. That's a problem. But the code is written such that certain diversification tests have to be met. And the details here are that essentially you can't have more than 25% of a single name going into seed the new ETF. So that would already disallow non-recognition. In other words, you'd have to pay tax on that contribution anyway. But where this gets sort of in shenanigans territory is where we have folks doing things contribution. So they'll borrow against maybe a concentrated position, they'll add some diversifying securities, and then they'll contribute that entire portfolio to meet the diversification tests on the way in.
And
now,
Brent,
that is not good. That is not what they were trying to achieve.
And Brent, let me ask, given the Treasury's obvious interest in this right now, what are you seeing in the market? Are people still launching these 351s given the fact that there's some concern that the Treasury is going to take some action?
Yeah, absolutely. I don't think that train has slowed down. What I'm seeing, though, is that maybe a little more diligence around what is a routine transaction versus what is potentially aggressive tax planning. And I think we're really going to find out who's swimming naked here when IRS does its investigations. We're going to find out who is using this to minimize transaction costs, to save investors, expense ratio, things like that, versus who is trying to achieve tax-free diversification.
Brett, let me ask you this. Let's say somebody's listening to this and they're like, okay, it's actually pretty smart to try to, limit your taxes, and it's all legal, but it's stretching the letter of the law. But I am also like the government to have some tax money so it can pay for things. The people doing this, let's say you're a real rich person, you do one of these custom 351s. Is their goal to sort of pass away, like when they pass away, to lose all of the tax basis because that's the law, right? Or do you think they'll ever realize the gain eventually? Like, what percentage of these people will realize the gain eventually versus just you sort of die with it not realized?
Well, it's hard to say, but I think something like a Treasury report came out and said something like 25% of the overall capital gains paid in a given year, something like 25% of that is mitigated or eliminated through step-up in basis. So it is a big chunk of the overall revenue in terms of capital gains that folks receive. But I think the planning opportunity here is really about timing. And so if somebody wants to defer the gains bill and then perhaps has losses from routine tax loss harvesting, then they can net that with the eventual gain that they might realize from this ETF. So it is not fully about estate planning and step up in basis. It's also about interim timing that can be achieved, and that's just routine tax planning.
So the ETF that, Zach, you profiled or you included in your story is has the ticker MIGO, and it was seeded with about $540 million of securities. Eric, do other people trade these ETFs? I mean, MIGO is available on the Bloomberg terminal. You can look it up. You can see how much in assets it has now. But is this something that other people could trade if they wanted to? What do the flows look like?
The flows obviously are custom because I really look at the volume. The volume is non-existent.
Okay.
Really,
so it's just for that person in that family.
Yeah, this isn't going to like sweep the nation as the big ticker everybody buys. AAUS, which is another one they use, that has a little more, but that's something that he uses constantly. So I think for ones that are custom, like MIGO, these are just for that purpose. Bespoke ETFs are not new here. They've been going on for a lot of years with ETFs. Typically, a bespoke ETF doesn't really ever make it. Like, it's usually just for this one person, like an anchor tenant. If it makes it, that's just bonus. So, Zach, I would just ask you, like, in your opinion, right, if you're looking at the industry and they're trying to be fiduciaries, and tax management is part of being a fiduciary, whether it's a separate account, direct indexing, or an ETF, doesn't it make sense to do all this?
Oh, absolutely. I mean, nobody's going to go around trying to pay more tax than they want to. I think, some of the light we've tried to shine on some of these things is that, these are coming pretty far afield from where, Congress back in 1967 or 69. 2 decades before the first ETF ever came into existence, really just wasn't anticipating, and at this point now has created this whole huge industry. So it's worth policymakers thinking about what the unintended consequences of their actions, and ultimately it'll be government that's going to have to decide if this is what they want to see.
Brent, has the SEC ever objected to a filing of a 351 conversion?
To my knowledge, that would be an interesting case, even though I do see them routinely get pulled down post-registration. And so an ETF sponsor will propose an ETF, and then they'll say, oh, this actually is not viable, even though we've allowed or we've offered 351. They just don't see any market traction from it.
Brett, this might be a little out of your purview, but one other thing is, like, I think ETFs probably pay a lot of taxes generally because look, I don't know if you saw the beginning of the show, they're going to end up trading like $70 or $80 trillion worth of shares. That's a lot of capital gains probably triggered because all ETFs live outside of tax-exempt accounts. So like, isn't there some maybe like karmic equality here because they already pay a ton of taxes because people trade them so much?
Yeah, definitely. And it depends on the structure of the ETF itself also. If the ETF is holding fixed income securities, then, I have not seen a 351 that is accepting, anything that could be redeemed in kind outside of just broad equities at this point. So, yeah, it's possible. It depends. But it certainly matters. The asset class matters.
All right, I think we're definitely at the start of something rather than the middle or the end with these 351 conversions really gaining ground, as Zach said, over the last couple of years. I want to thank our roundtable, Brent Sullivan of Tax Alpha Insider and Bloomberg's Zach Miter on this story. 351 conversions, we're going to be talking about it again. Just a reminder that you can listen to Eric and Joel Weber on Trillions, their podcast that covers the entire industry. Have you guys talked about this before?
We have.
Okay.
We interviewed Zach a couple years ago.
Well, Zach will be on again, sure, soon, I'm sure. All right, Joel will be joining us at the end of the hour for our IQ test as well, along with Cinthia Murphy. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu. Let's get you to the ETF Lifecycle, where we walk you through the three main stages of ETFs, from initial filings to final farewells. Step one is the filing. Grayscale submitting paperwork for yet another crypto ETF. This one will be a WorldCoin ETF trading under the ticker GWLD. If you recall any of the buzz in recent years around the metal orb that scans your iris as proof of humanness, this is the crypto behind that technology. It was co-founded by OpenAI's Sam Altman. The SEC now reviewing that. Step two is the launch. Alpha Architects U.S. Equity 4 ETF is now trading. Ticker AAUB is one of those 351 exchange ETFs that we just discussed. This one launched with more than $800 million in assets. And for some, the final stage is farewell. Ticker EMTL is no more. The State Street Double Line Emerging Markets Fixed Income ETF calling it quits after a decade. State Street and Double Line still have some other co-branded ETFs, such as TOTL and STOT, but EMTL, this one that liquidated, was much smaller than those, with $67 million in assets when it shut down last week. And that is your life cycle. Now, I want to mention some headlines from President Trump speaking from Air Force One. He's talking about new Fed Chair Kevin Warsh, who, of course, will be convening the FOMC this week. He says Warsh will do the right thing. I know what he wants. He also made some comments about the Federal Reserve overall. President Trump saying he read a very good inflation report the other day, and there's a good chance that something could happen with Iran in talks, referring, of course, to the fact that there has not been any kind of military strikes the last 3 days. It's kind of a pause in the military activity, and that has caused oil prices to come down. President Trump saying in a previous comment earlier today that he is hoping, or he is creating some space for talks between the U.S. and Iran. Coming up on Bloomberg ETF IQ, it is time for an IQ test where Joel Weber puts our ETF knowledge to the test. Here is a sneak peek at one of the questions. What percentage of ETFs launched this year are still below break even today? Wow. Is it 12%, 44%, 78%, or 86%? That answer coming up next when we have our ETF IQ test. This is Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Eric Balchunas. It's time now for an IQ test, and we're so pleased to welcome back Cinthia Murphy of TMX VettaFi to join us today in place of Katie, who's on leave. Bloomberg's Joel Weber is going to see whether Eric, Cinthia, and I really know our stuff when it comes to ETFs. And Joel, of course, co-hosts the Trillions podcast with Eric. He's also our head of games at Bloomberg. So, Joel, you have spent the weekend coming up with these questions.
Yeah, I was doing other things this weekend, but I did have these ready. Cinthia, welcome.
Thank
Let's
you.
see how you do. Our first question. The ticker MIGO, a 351 conversion, which I know you were just talking about, was seeded by the family behind which snack brand? A, Hot Pockets, B, Chex Mix, C, Skinny Pop, or D, Pirate's Booty?
You just picked these based on the names, right?
You know, it was a fun one.
Hot Pockets.
Eric?
It is Hot Pockets.
I'll go with that.
Way to go with it. Eric cut you off. You're supposed to go second. Hot Pockets is right.
Oh, sorry. I need to
We'll get the order right here. Okay.
Sorry.
Next question. Congrats, you're on the board. Everyone's having fun. Let's make it not so fun. What percentage of ETFs launched this year are still below break even today? A, 12%, B, 44%, C, 78%, or D, 86%?
Given how high the numbers skew, I know it's not A, so I'm thinking it's either B or C. I'm going to go with C.
Cinthia?
I'm going to go with D.
Okay.
Ooh.
Eric?
I'm going to go with C.
Okay. And our answer is...
Cynthia!
Newcomers on the board.
Nice
Dude.
job.
All right, way to rub it in.
You better miss this next one, or you're never coming back.
Let's see if she can sweep. Okay, in 2026, how long had the average ETF been on the market when it closed?
Ooh. Oh, yes.
A, 2.3 years, B, 4.1 years, C, 3.8 years, or D, 5.4 years?
The average ETF.
Yeah.
Oh, God, I have no idea. I'm going to say A.
Cinthia?
So this is the ETFs that closed this year that launched.
Yep, and the average length of time?
A, 2.3 years.
Eric, what do you think?
Damn, because now I'm going to say A is the answer, which means she got all of them.
Okay, let's see if that's right. Yeah, Cinthia,
Cynthia, you're welcome back anytime.
That's awesome.
How many times have you gotten all three right, Eric?
He's lost track. Of course, if you like playing games, you can go to QuizGo on the terminal, where we have a news quiz for you, and online, go to bloomberg.com/pointed, where we've got a news quiz where you can play with leverages, among other things.
To be fair, he asked my team, and their whole goal is to get questions I won't get.
Right,
so there are people working against me.
I tend to do most of the heavy lifting. Yeah.
So if I win, it's in spite of that.
Right. You've overcome hurdles, right?
Yeah.
Cynthia, is this something like, have you watched our quizzes before and thought, like, these are some really obscure questions?
I have, and I ran into Athanasios outside, and I'm like, how do you guys come up with such obscure questions? Because that's the point. So, yes.
So I did not spend the weekend writing these, but she spent the weekend researching them.
But you have a lot of help.
Ready.
You have a lot of assistance from people around the world.
Yeah, we go to Eric's team and try and recruit something out of them. And then I end up reading all the research.
The worst is Rebecca,
the
because she's in Asia, and there's so much weird stuff going on over there.
That's the only way that I think to get every answer right.
I'll take the obscure trivia is great stuff. So.
All right, thank you so much, Joel Weber and Cinthia Murphy of TMX VettaFi for this edition of Bloomberg's ETF IQ test. That does it for Bloomberg ETF IQ, the television program. I'm Scarlett Fu, along with Eric Balchunas. Be sure to tune in next week at the same time, same place. This is Bloomberg.